We had a strong week in the S&P 500 with record highs, and when we take a look at some of the large gainers, we can see the semiconductor industry as a whole had some very strong performances, notably Micron Technology up nearly 20% off the back of some very good earnings. And when we take a look, in fact, out of the last week, the index increased 3 of them, where we see it is up 21% year to date, and in fact 0.13% below the record close. On top of that, we also note that the market sentiment is very strong, currently sitting at greed, although we were sitting in the neutral space around 1 month ago, and you have to go back a year to see extreme fear. Now, as we always say, the market can change very quickly, so don't be under no illusion we could move into any one of these categories just over a few day period. Now, today's episode, we are taking a look at 8 undervalued dividend stocks with some very large gains anticipated over the longer term. As always, we'll look at their historical performance. We'll also touch upon their earnings, how they performed in the past, as well as expectation moving forwards. And we'll look not just at the high-level metrics, which will include each one's dividend safety, but we also want to run through dividend yield theory, compare how the companies performed in terms of a forward P versus the 5-year average, as well as run into some of the bare details in terms of the free cash flows, the ROICs, as well as many other details that you really need to understand for each company. As always, we are going to run through each one in the valuation model, getting to our own intrinsic value, discussing our margin of safety, whether we see 10, 20, 30%, as well as what Wall Street anticipate in terms of upside just over the next 12 months. We also have earnings next week with some very large names. In fact, we have Nike reporting after the market close on Tuesday, and as always, make sure you are subscribed to this channel where we do an in-depth look of how the company reported in their earnings. Now, one thing that we have seen in terms of investors moving forwards, they are anticipating the rate cuts to continue in a very strong manner. They're in fact expecting 50 basis points from the Fed in November, so do have a look at your portfolio to understand where you expect this to be over the next few months. We also had Visa last week being accused by the Department of Justice, very similar to what we saw with Google as well as Microsoft quite some years ago, where they have in fact called them an illegal monopoly over debit payments, and as such the share price did drop. As you have seen, this is one of the stocks that we are covering in today's analysis, and one of the best investors of our generation, if not the best, Nancy Pelosi, as well as her husband, did sell Visa shares a couple of months ago. In fact, we can see 2,000 shares being sold in July. Whether or not you agree that people in positions of power are able to buy and sell shares, that is something to discuss for another time, but very interesting to note, she always does seem to be 2 or 3 months ahead of the market. Final thing then, just to note, as we said, semiconductor industry looking very strong last week, and one of the biggest winners were Micron Technology. They reported some very good earnings as well as forward guidance. And why the market likes this as a whole? Well, it means not just for MU, but also for the semiconductor industry, that the AI demand is continuing to increase in line, if not more, with expectations from what the analysts were hoping for. So lots of bullish news that has come out last week. One of the reasons why, in fact, the S&P 500 performed very strongly. And before we jump into Visa, which is the first stock we are discussing today, we do want to let you know that we have in fact released our latest free weekly article. We drop one of these to your inbox every single Monday, where we look at what's happened in the market in the previous week, as well as some undervalued dividend stocks that we do believe you should consider for your portfolio. Completely free. You can click the pinned comment below to sign up and read straight away. And you can also then access 25 undervalued dividend stocks for the month of September for your consideration, where we run through each one that sits within our own portfolio. And in fact, on Monday, we will now be sending out the October edition, so do make sure you are signed up to receive a copy, as well as the fact that within this, you are able to grab our 22 dividend stocks, which has the largest upside according to Wall Street analysts. So again, something just for you to see whether or not these fit within your own portfolio. So jumping into Visa, we have a double buy rating and a hold from quant. This is also one that we hold within our own portfolio and currently trades in the upper end of the 52-week range, although we can in fact see it has pulled back from its all-time highs of $293. Now, in terms of a yield, it does sit at 0.77% on a forward-looking basis, with a forward P of around 28. For those that want to know for context, S&P 500 right now does sit around 28. Over the last 10 years as well, it is up 414%, so it has outperformed the S&P 500 significantly. And in fact, if you were reinvesting those dividends, it would be up marginally higher. Just over the last 12 months, we do see this company up around 20%. Now, in terms of their earnings, over the last 4 quarters, they have either been in line with management targets or outperformed, so very nice to note, a 100% track record. And in fact, out of the next 4 quarters, 3 of them, they are anticipating double-digit increases to the EPS year on year. In terms of September 2025, so their next full annual accounts, they are anticipating that forward PE based on the EPS estimate to come down to around 24.86. In terms of looking at these metrics, well, at a very high level before we dive in, 99 score on the dividend safety, very safe, in fact the highest score obtainable. We also get the yield that we mentioned, we'll cover this valuation, and we can see very consistently double-digit increase in October last year at 16%. In terms of dividend safety of the 99 score, well, that was just reaffirmed last month, and what it ultimately means is that a dividend cut for Visa Corporation is highly unlikely. Now, for each one of these companies, we are going to look at some key metrics, which are effectively how they performed in the Great Recession 07-09. We note here, in fact, that Visa increased their dividend. They had plus 9.5% recession sales, which was above the average growth. Remember, the S&P during that time was negative 12%. Now, as we mentioned, we do love this company, especially as dividend growth investors. Double-digit increase on average over both the last 5 and 10 years. And one thing to note, their increases come every single October. So just over the next few weeks, we are expecting, again, another double-digit increase. We can also see this is a company that has increased those dividends consecutively for the last 15 years. Now, valuation, this is based on the average P ratio. We do get a reasonable signal, which as we do take a look over the last 12 months, this has pretty much been trading right at the bottom of the expected fair value and continues to do so, so something just to consider. One of the methods that we typically like to look on this channel is dividend yield theory. Now, this states a company is undervalued when the current yield sits above the 5-year average, so you could argue right now reasonable / slight undervaluation. However, on the forward PE, 25.7, that is below the 5-year rolling of 28, so you could class that as an undervaluation signal. Bear in mind, we don't look at any of these models in isolation. We will conclude when we get to the valuation analysis. And what we can see here, the sector P for financials trades much lower at 12.2. But as always, bear in mind, there will be some low quality companies within this bucket. And we do believe that Visa deserves to trade at a premium. It is a high quality company. We'll show you now through the metrics. The question as an investor you need to ask yourself is, how much of a premium does this company deserve? And that is what we are going to go through when we do come to the valuation models. Now, free cash flow payout is one we draw your attention to consistently, as the earnings is susceptible to manipulation by management through accounting, and below 60% is the target. Reason for this, it gives us faith management can consistently offer double-digit increases that Visa has always done. Now, over the last 10 years, hasn't really been above 20%, 19 in 2023, 21 anticipated over the next 12 months. And as we mentioned, we do expect a strong increase over the next few weeks. Now, free cash flow per share, as always, we want consistent increases year on year. Maybe not very consistent, but it has more than tripled from 2014 to 2023. And as we can see, over the next 12 months, that increase year on year is anticipated to continue. Then we get to sales growth, where we target 3 to 7%. Remember, the lower end of 3 to 4 is just to keep up in line with inflation, but pretty much every single year this company has reported double-digit increase to the top line. -5 justifiable for the COVID period in 2020, 11% as we can see in the more recent year. And when we look at it from a numerical perspective, we can see more than doubled over the last 10 years. In fact, nearly tripled, currently at 32.7 billion. Now, on top of that, what they've also done in terms of shares outstanding are share buybacks, which ultimately returns excess cash to investor pockets as you gain a larger portion of control of the company. In fact, very consistently on a year-on-year basis, this is something that management have done, and we do anticipate them to continue to do. And remember, a nice bonus on top of those dividend increases. Now, in terms of ROIC, it is one of our favorite metrics on this channel. 10% or more, give us faith, management are able to effectively allocate their capital, and we see that every single year. In fact, 31, 34%, 36 on a trailing 12-month basis is very, very strong. You won't don't see this a lot in companies we review, and makes it incredibly attractive for both new shareholders as well as current shareholders to consider in their portfolio. We then move on to the operating margin. Now, first thing to note, what we want to see here are increasing margins over the longer term to get that operating efficiency. The second is the minimum 12%. Now, Visa, very, very strong. This might be one of the best margins we come across. 64% in 2014, 67% in 2023. Very, very impressive. And margins don't stop there. Above 5% on the free cash flow. Just look at these numbers. Very impressive. Last 3 years, very strong as well. We would classify this as a free cash flow machine. Then we move on to the final metric, which is the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 3 is our target, and the numbers that you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Look at 2016, that is the highs of 0.76. Since then, it has come down 0.05 in 23, 0.14 over the next 12 months. And why we like this metric, remember it correlates to dividend safety and balance sheet strength. So this ultimately tells us Visa have an incredibly strong balance sheet, as well as no surprises that we did see that 99 score on the dividend safety. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $323, how we got that in today's episode? Well, we ran it through a few models, and typically on this channel we do deep dives. We look at the inputs and outputs. Today we're jumping straight through. So our margin of safety, typically we like to start off with 10%, and we execute on that if it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, in today's episode it is a buy at around $290. Then we keep going till it's near the current trading price. And ultimately today we are saying Visa has a 15% MOS with 15% upside from Wall Street at $317. Now, for some people that may not be enough in terms of a margin of safety. So just to show you, for example, at 20% it would be a buy at 258, and that was the previous levels where we did top up our position in the portfolio, and one that we would consider a very good price. Even though right now at 15% margin of safety, we still believe this to be very attractive for the long term. You are getting a company which is very high quality. The margins are very impressive. Metrics as a whole looking very, very strong. And over time, this one we do believe will continue to outperform the S&P 500. As always, when we go through these stocks today, do give us your thoughts in the comments below. We then move on to the pharmaceutical giant. It is Novo Nordisk, where we can see we have a double buy rating and a hold from quant. This one trades right now in the midpoint of the 52-week range with a forward yield higher than Visa of 1.16%, but it also has a higher forward P of 35.2. Over the last 12 months, very strong, outperformed the S&P, up 32%, and over the last 10 years, again, outperform of the S&P, pretty much in line with Visa's performance over the last 10, up 425%. In terms of management targets, we do know over the last 4 quarters, they have beaten 3 of the 4, which is a 75% track record. However, the more recent quarter was a marginal miss by 7 cents. Over the next 2, quarter 3 and quarter 4, they are anticipating strong double-digit increase to the EPS, with the next full year estimate of 4.31, bringing down that forward P to a much more reasonable 28. In terms of the metrics, well, similar to Visa, 99, very safe score. We have a reasonable valuation, which we can take a quick look at, and a very, very impressive dividend growth of 52%. Now, as we mentioned, dividend safety 99, ultimately dividend cut is highly unlikely. And the last recession, well, they did in fact increase the dividend. They had plus 6% sales, which, as we said, above average growth of negative 12, but they significantly outperformed the S&P, negative 27, when during the same time, the S&P 500 came in at negative 55. We also love to see this dividend growth, 52% over the last 4 years, 18% over the last 5, 21% over the last 20, and in fact they are a dividend aristocrat with 25 plus years of increasing those dividends on a consistent basis. Now, if we have a very quick look at this valuation model, as we can see over the last 12 months, this company has been trading above its intrinsic value. Right now, it does look to be in the midpoint of that bucket, but as always, we will have a look at our own valuation model. In terms of dividend yield theory, well, the yield of 1.19 is below the 5-year average of 1.45. However, the forward P right now pretty much doesn't sit too far off, 31.4 versus 30.2. and we do also note it does sit significantly higher than the healthcare sector of 16.9, but similar to Visa, we do believe this company, NVO, does deserve its premium. Now, in terms of the free cash flow payout, below 60% is what we want to see. It is pretty much bang on that in 2023. Over the next 12 months, expected 52%. So again, we would be very surprised if at a bare minimum for Novo Nordisk, we don't get at least a double-digit increase. We also note here on the free cash flow per share, it has tripled over the last 10 years and is expected to increase at a very favorable rate over the next 12 months from 15.6 to 18.5. Then we get to the sales growth where we get that double-digit increase for the majority of the last 10 years. Very impressive over the last 3 from 11% to 31%. But we do also note they did go through a period where their top line did remain flat. Now, from a numerical perspective, what we can in fact see is that this company has increased more than double over the last 10 years, 232 billion currently in 2023. Again, similar to Visa, they have done those share buybacks on a consistent basis, and this is pretty much a very strong indicator of a company you do want to consider, not just double-digit increases to the dividend, but also those that do consistently have those share buybacks. Now, ROIC, I thought that Visa was very, very strong. Look at NVO, in fact, very impressive, 72% in 2023, 65% in the previous year, 66% on a trailing 12-month basis. So this is definitely one you should consider if you do think it fits into your wider portfolio. Operating margin, we can see well above the 12% minimum and increasing over the longer term, 45% in 2023, and in fact free cash flow looking equally as impressive in the 30s over the last few years and pretty much for the majority of the last 10. So lots to love about this company. And then we move on to the net debt to EBITDA, well below 3 consistently, 0.1 in 23, 0.06 over the next 12 months. So you can clearly see this is a very high quality company, but as always, we do need to take a look at the valuation. Now, our intrinsic value in today's episode does come to $134. We can see Wall Street a little bit more bullish over the next 12 months. They have a price target of 144 and they see 20% upside. Now, in terms of margin of safety, at 10%, that is pretty much where we do see this company right now. For some people, that may be sufficient to start dollar cost averaging in. For others, they'd happy to buy this at a premium. And there are other investors who do want to see a larger MOS before considering. So at 15%, a $114 price target. At 20% MOS, around 107. And for those that want to see a 25% margin of safety, you would need to wait from the $100 mark. So in conclusion, for today for NVO, we see a 10% MOS with 20% upside, and very similar in terms of our discussions on Visa. We do see this as a very high quality company that you could group in the same bucket in terms of companies that you should own if you do want to continually outperform the S&P 500. As always though, do give us your thoughts below. We then move on to Elevance Health, which is also similar to Visa, one we hold in our own portfolio. We have a strong buy rating from Wall Street, a buy from Seeking Alpha with a hold from Quant. This one currently trades in the upper end of the 52-week range, although we can see it is some way away from its all-time highs, with a yield of around 1.25% and a forward PE sitting around 14.1. Now, over the last 12 months, it is up around 18%. Over the last 10 years, it has again outperformed the S&P, up 330%. In terms of performance, well, we do like to see this 100% track record in terms of the last year's performances, and over the next 4 quarters, we do get 3 of them being double-digit increases to the EPS, and as we can clearly see, with the earnings per share expected for December 2025, that forward PE will come all the way down to around 12.6. Nice to note, 3 for 3 in terms of dividend rating of 99, very safe. We do get that reasonable valuation with a very impressive double-digit increase just this year. Now, in terms of how they performed in the last recession, well, no dividend was paid, so we don't have any comparative data. They had negative 4% recession sales, still above the average, and we do note they did marginally trail the S&P with their negative 61% return. Also, very, very strong, very consistent so far in the companies we have selected today. These have also increased their dividend over the last 5 and 10 years at a double-digit rate. And also, we do like to see this 12 years of consecutively increasing those dividends. Now, in terms of the valuation, we do have that reasonable signal, and when we do zoom in on over the last 12 months, we can see it in the mid to lower end of the expected bucket of this company's fair value. In terms of dividend yield theory, well, we have that reasonable valuation both on the yield as well as the forward PE, both metrics signaling to us that it is trading around the 5-year average, although we do note it does sit lower than healthcare at 16.9, as we said ELV around 13.3. Then we move on to the free cash flow payout, where we do get below 60% every single year and quite significantly below 21 over the next 12 months, which again indicates to us that for Allegiance Health, we are expecting those increases to continue at a very favorable rate. And free cash flow per share also looking very strong, in fact tripled over the last 10 years, 962 to 28.7, with an increase anticipated over the next 12 months to 31.4. Then we move on to the sales growth, where we get some very strong numbers, and when we do look at it from a numerical perspective, we can see more than doubled over the last 10 years, as well as having that added factor that we do like and we have seen in both Visa and NVO with those share buybacks over time. Now, when we take a look at the ROIC for this company, we want to see 10% or more, which is pretty much where we do look at for the majority of companies as a whole. That is exactly what we get. 15% in 2023, 14% on a trailing 12-month basis. So always good to see that, especially for companies we do consider. Now, operating margin, while we do want to see above 12%, this is pretty much what we do see as the sector as a whole, so no surprises there. Somewhere between 5 to 7% on a year-on-year basis, with 6% on a trailing 12 months. So whilst we do want to see higher margins, this is something that is very consistent, and likewise to be said for the free cash flow margin, we do want to see around 5%, which is pretty much near enough what we do get on a consistent basis, with 4% in 2023. We then move on to the final metric, net debt to EBITDA. This is the best one we have seen today because that is 0 right across the board, and this signals to us for Allegiance Health it wouldn't even take them one day to pay off all of their debt net of cash on hand. So let's jump into the valuation. Now we have $590 as our intrinsic value. Wall Street a little bit higher at 607. They see 16% upside, and when we do put it through the MOS at 10%, a buy at 531. At 15%, not quite there yet, so you could say for this high quality company around 10 to 15%, with Wall Street anticipating 16% upside. Now for those that want to see a little bit higher, well, as we said, 15% around the $501 mark, at 20% around 472, but right now 10 to 15, and as we said, a very high quality company, one that we would group within both Visa and NVO. The next stock we are looking at is Alphabet, one that we still believe is a very good contender for one of the best valued companies in the S&P. In fact, it is the cheapest valued company in terms of forward P in the Mag 7, with a double buy rating and a hold from Quant. This one trades in the midpoint of the 52-week range, a forward yield of 0.5%, and a forward P of 21.5, which is lower than the S&P 500 itself. Over the last 12 months, up 26%, outperformed the S&P, as well as over the last 10 years, up around 460. In terms of looking at their earnings, well, no surprises. Over the last 4 quarters, they have outperformed, and very strongly as well. And over the next 4, they believe 3 of the 4 will be double-digit increases, ultimately bringing down the forward P of December 2025 to 18.83. Now, dividend safety, we do see an 80 score, but bear in mind they just recently paid a dividend, so when we do get more increases, this will better reflect the actual true nature, but we do believe it to be justified around this point. We have the undervaluation signal, and as we mentioned, they just recently paid a dividend. Now, what does 80 safe mean? Well, rather than being very unlikely, we say a dividend cut here is unlikely. In terms of the last recession, well, they didn't pay a dividend, so no comparative data, but they did have plus 8.4% sales, which, as we've already said, is above the negative from the S&P. Now, in terms of valuation, the undervaluation signal is here, and the reason for this is that over the last 12 months, for the majority of this point, it has traded below the fair value bucket. Right now, it is very, very undervalued according to this model. As we said, we will take a look within our own model, and when we look at dividend yield theory, you could argue reasonable valuation on here. Remember, they've only recently paid a dividend, so we would say this model is redundant. In terms of the forward P at 20.4, that is significantly lower than the 5-year rolling of 23.2, and we note it is marginally higher than the sector of communications as a whole, but we would just like to reiterate the comments we said for the previous 3. We also believe Alphabet is a high quality company. We then move on to the free cash flow payout. Now, given they've only recently paid, over the next 12 months at 12% expected for the ratio, we do believe, similar to the previous companies, they will increase these dividends at a very rapid double-digit rate. We then move on to the free cash flow per share, and as we've always wanted, increases over the longer term. In fact, more than 5 times increase from 2014 to 2023, still expected to increase very sharply over the next 12 to 664. We then move on to the sales growth, where we get nearly double-digit increases every single year. Pretty much the only year wasn't 2023, but that was a nice 9%. And the trailing 12-month of 13% does indicate to us that 2024 likewise will be a very strong year for Alphabet. Then when we look at it from a numerical perspective, we still see that growth looking very strong, around 4 times. And what we get from this company in terms of share buybacks are actually share issuances from 2014 to 2018. Since then, they have been doing share buybacks at a fairly rapid rate, and we do anticipate this to continue. In fact, over the last 10 years, even though they have been doing share buybacks and share issuances, they bought back a net position of 1.1 billion shares. We then move on to the ROIC, which looks very strong. No surprises here. Also been increasing over the last 10 years. Last 3 years in the high 20s, always a great sign. And in fact, trading 12-month at 31% does mean that this is very impressive. And as always, the reason why we focus on this metric, it does give us faith that management are able to effectively allocate their capital. We then move on to the operating margin, above the 12% we want to see, increasing over the longer term at 29% in 23, 31 on a trailing 12-month basis. So no worries whatsoever, no worries with the free cash flow, although it can be very inconsistent over longer term, still some very impressive numbers, 23% in the more recent period. We then move on to the net debt to EBITDA, very, very similar to Leavens Health, 0 right across the board for Alphabet. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand. So let's get to our valuation model. Now for this company, we essentially say the intrinsic value is equal to the DCF model at $188. Now we'll show you how we got there. Effectively, we have the free cash flow year on year. Average growth is around 24% over the last 10 years. And we've gone for 10% moving forwards. As you can see, we have a low, medium, and high rate. Today, we've gone for the low rate of 10%. With the discount rate of 8%, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 188 indicating around 15% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others, and just for transparency, we'll show you the other rates. So at 15%, if you believe that 10 is way too conservative, 265, as we see here, indicating 63% upside, and 20%, which is in fact still lower than the average of the last 10 years, giving us 372 intrinsic value, 128% upside, indicating if they hit that, and if you strongly believe that, right now you can more than double your essential investment by buying this company. As we said though, we will take through the 10% to the next slide, and with that we have that intrinsic value. In terms of margin of safety, well at 10%, a buy up to 169. At 15%, it isn't quite there yet, but around the $160 mark, we see on what we would say is a very, very conservative basis, based on essentially 10% increases moving forwards, that this company has a 10 to 15% MOS. And Wall Street, unlike us, they have a very high target, $206 with 26% upside. So as we said, right now 10 to 15%, but do give us your thoughts. This is definitely one of the strongest companies in terms of valuation that we do believe is considered for every portfolio. We then move on to Occidental Petroleum, where we have 1 buy rating from Seeking Alpha, a double hold from Wall Street and Quant. This one is trading not only right there at its 52-week low, but right now you would be buying this at a cheaper price than Warren Buffett's average cost. We can in fact see a yield of 1.76%, a forward P of around 14, and over the last year it is down 22%. Over the last 10 years, down around 47. Now when we take a look in terms of their earnings, well, last 4 quarters and by quite some distance in the more recent one, they have outperformed management targets. Next 4 quarters, understand this industry is very cyclical. We do get 2 decreases anticipated, with also 2 large double increases to the EPS. So ultimately, the EPS is anticipated to increase over the next full year, bringing down that forward PE to 10.83. Now we do get our first borderline safe score in terms of dividend safety at 60. We have the reasonable valuation here with a very large double-digit increase in December at 22%. So dividend safety, first thing to note, it was just reaffirmed around 4 weeks ago, and what it ultimately means is that there is a moderate risk of a dividend cut over a full economic cycle. Now, how did they perform in the last recession? Well, they increased the dividend, they had below average growth, but they also significantly outperformed the S&P, negative 23%. As we said, very impressive increases to the dividend last December, but do note they have had a dividend cut over the last 5 years, which ultimately shows up in over the last 20, where it's only increased by 2%. That is below the inflation target we have on this channel of 4%. Reason why we use this 4% is that the US inflation rate over the last 40 years has been around the 4% level. So if you're getting anything less, whether that's your dividends, your other income producing assets, or in fact your salary, you are taking a pay cut and losing your purchasing power. As we can see here, 2 years of consecutive increases. Now when we take a look at the valuation based on the P ratio, we can see over the last 12 months, it has been very inconsistent, right now trading in the middle of that blue bucket. In terms of dividend yield theory though, we get a massive undervaluation signal, 1.72, significantly above the 5-year rolling, with the forward P around 30, not far off the 5-year 12.8, and we can see again not far off the energy sector of 12.9. Now when we take a look at their ratios, well, we can see the free cash flow payout ratio is in fact below 40% over the last few years, 17% expected over the next 12 months, so we can see why they are expected to continue to increase those dividends at a double-digit rate. Free cash flow, as we said, inconsistent essentially industry, will show through the numbers, but it has increased over the longer term. Do understand though, over the next 12 months, it is anticipated to drop to around $5.18. Sales growth, as we said, it is starting to show through the numbers, the cyclicality. In fact, out of the last 10 years, 5 of them have been negative, including 2023. And when we take a look at it in terms of a numerical perspective, we can clearly show that from the peaks and troughs year on year. We also have to point out that unlike the previous companies, there is no returning of excess cash. In fact, it is the opposite where they have diluted your position, with shares increasing 781 to 954 in the latest quarter. We then take a look at the ROIC. It has looked fairly decent over the last few years. Previous to that, we get a lot of inconsistency year on year, but do understand with cyclical companies, we want to buy them when they are out of favor, when no one wants them, investors are selling them, and then riding them up right to the peaks. Margins also looking very strong over the last few years, both on the operating side as well as the free cash flow, looking very healthy as well on the trailing 12-month basis. And then in terms of the net debt to EBITDA, we want below 1.5 for this specific industry, oil producers, 1.28 in 2023, 1.19 over the next 12 months. So it does look okay considering that the free cash flow payout is also lower than the maximum we want to see. So the dividend for now for Occidental does look to be safe. Intrinsic value then at $73 is pretty much around what Wall Street see at 71. They have 39% upside, so definitely one to consider maybe if you don't have this industry within your overall portfolio. 10% MOS will buy at $66, 15% a buy at $62, and as we can see in today's episode, there is quite a large MOS. At the 30% point, $50.95 is where we see this right now. So quick conclusion, Occidental Petroleum, 30% margin of safety, Wall Street giving this 39% upside. Do let us know whether or not you have been buying these companies, as well as others that do look very favorable right now. Chevron, ExxonMobil, Shell, BP, and a few others. We then move on to Johnson & Johnson, the dividend king. We haven't looked at this in more recent period. We have the double buy rating, a hold from Quant, another one that sits within our own portfolio, trading at the mid to upper end of the 52-week range, with a yield of around 3.1% and a forward P of 16.1. Over the last 12 months, well, up around 3%, underperforming the S&P. Over the last 10 years, again, around 53%. As we can see, this would have similarly underperformed. In terms of their earnings, over the last 4 quarters, they have outperformed the management targets. Moving forwards, we can in fact see 3 of the 4 anticipating a decrease to the EPS year on year. But ultimately, over the next full year, they are expecting it to increase, lowering down that forward P to around 15.1. Dividend safety, well, nice to note the very safe score, attractive yield, we have the undervaluation signal, and they did increase the dividend this year, April, pretty much in line with inflation. So when we take a look at how they performed in terms of the last recession, well, they actually increased the dividend above average growth and also significantly outperformed the S&P, negative 27%. Dividend growth as well, we said inflation increase in April this year, 6% over the last 5 years, with a nice high single digit increase of 8% over the last 20. And one thing that we can see with this company, not just a dividend king with over 50-year increases, but in fact they have been paying a dividend for 108 years without a reduction. Now, in terms of the yield, we can in fact see that over the last 12 months, this company has been trading right below its intrinsic value. And when we do take a look at dividend yield theory, we get a very similar conclusion, 3.07 above the 5-year rolling, with the forward PE trading pretty much in line with the 5-year average of 16.5. In terms of healthcare though, the sector as a whole does trade only marginally higher at 16.9. Now, in terms of the free cash flow payout, pretty much consistently below 60% year on year, other than the last 2 years. Nice to see over the next 12 months dropping to 53%, so hopefully we can get above inflation increases moving forwards. We also note increases to the free cash flow year on year, but again, understand the companies you invest in have realistic expectations. This isn't going to be similar to some of the other companies we've reviewed today, where we do anticipate massive increases year on year. Nice, however, to report a large increase expected over the next 12 months. We then move on to the sales growth, where we do get a little bit of inconsistency. 2 of the last 10 years have been negative. Nice to see not just the full year at 6%, but also on a trailing 12-month basis at the 5% point. Numerically speaking, though, over the last 10 years, they have at least been keeping up in line with inflation, and maybe a little bit inconsistently, something we would like to see a little bit better. They have been doing share buybacks, but not on a year-on-year basis. We then move on to the ROIC, where you get consistency right across this metric in the high teens, in the low 20s. Always great to see when the minimum we want is 10%. And margins, both on the operating side, where we get above 12% consistently, and on the free cash flow, we do notice some very good numbers. You could argue that Johnson & Johnson is pretty much a very consistent company to have in the portfolio, and is one that we do expect, if we do get another recession soon, it will essentially outperform the S&P. As well as that, it has one of the best balance sheets globally alongside Microsoft, with some very favorable ratings. 0.25 in 2023, 0.51 over the next 12 months. So we do quite like this company if you do want to have some stability. In terms of the valuation, well, our intrinsic value at $185, pretty much bang on with Wall Street at 185, where they see 15% upside. And when we look at it in terms of margin of safety, well, at 10%, a buy at 166. At 15%, not quite there yet at 157, but not too far off it. And it really depends what type of investor you are. We've covered a lot of stocks so far that don't particularly have a fairly large dividend yield. So this could definitely be one if you want some stability, you want that consistent yield. As we can see, they've been paying a dividend for quite a number of years. In fact, more than 100 without a reduction, as well as being a dividend king. However, as we said, between 10 to 15% MOS, with Wall Street indicating 15% upside. We then move on to a highly underrated company, Domino's Pizza, with a double buy rating and a hold from quant. This one trades in the mid to lower end of the 52-week range, with a yield of 1.4%, a forward PE of 26.5. Over the last 12 months, up around 13%. Over the last 10 years, though, it has significantly outperformed the S&P, up 453%. They've also outperformed management targets over the last 4 quarters, which is always great to see. And even though they do anticipate a decrease to the EPS in quarter 3, we can see over the next 3 after that, they do expect 2 of them to be double-digit increases. Ultimately, increase to the EPS in December 2025, leading that forward PE to around 24.14. Now, we do get another borderline safe dividend score with the undervaluation signal and a very attractive increase of 25% in February to the dividend. As we already said, borderline safe score ultimately meaning a moderate risk of a dividend cut over the full economic cycle. Now, no dividend was paid in the last recession. They did have above average growth, and we can also see they did marginally trail the S&P, negative 66%. Dividend growth, well, you'll love this company if that is something you consider. 25% in this year, 17% over the last 5, 20% over the last 10 years, and they have been increasing those dividends for the last 10 years on a consecutive basis. In terms of the valuation, well, we can in fact see when we zoom into the last 12 months, over the more recent period, this has been trading below its intrinsic value, giving it that undervaluation signal. And in fact, we get another undervaluation signal both on the yield as well as the forward PE, which is always a good sign if you are looking for some very strong companies to consider. Although do note that consumer discretionary sector sits much lower at 14.5. We then move on to the payout ratio. Well, for restaurants, we want to bring it down to below 50%. They have done that every single year. 35 in 2023, 36 anticipated over the next 12 months. So no surprises why they are able to continually increase those dividends. Free cash flow looking very impressive, maybe one that you hadn't thought of before, but just look at the increases on a year-on-year basis. In fact, over the next 12 months, some large increases expected to continue. and sales growth also looking very impressive when you do zoom out. Bear in mind that over the more recent year, their top line did decrease by around 1%. Numerically speaking though, not only have they more than doubled their top line, but just look at the shares outstanding. They have been aggressively returning excess cash to investor pockets, as we can see, something they do on a consistent basis year on year, quarter on quarter. We then move on to the ROIC. Again, this is very impressive. At the beginning of the episode, we saw Visa, we saw NVO, we saw ELV with some very nice ROICs. Domino's Pizza looking very, very impressive over the longer term. Do let me know if this is one you had previously considered for the portfolio. We then look at margins, where it's consistently straddling around the minimum 16% we want to see for the industry, as well as a free cash flow margin higher than the minimum 5%, pretty much double digit every single year, 11% in 2023. We then get to the net debt to EBITDA, which is probably one of the drawbacks of this company, where we do get that borderline safe score. We want below 3.5 for restaurants, been higher than that every single year, 5.17 in 2023. Nice thing to note here, anticipated to come down sharply to 4.5 over the next 12 months. But again, we do want to see this go lower, something to consider when we are looking at the margin of safety. Now, our intrinsic value of $507, when we do run it through the MOS calculation, at 10% a buy at 457, at 15% at 431, not quite at the 20% level yet, so we do see it somewhere between 15 to 20%, with Wall Street giving this a 16% upside target, forecast price 496. As always, do give us your thoughts. This isn't one we have covered too recently, so maybe something you could consider for the portfolio if it does interest you at the very high level that we just reviewed. We then move on to Realty Income with a triple buy rating. The first time we have seen this today. Now, whilst this does trade at its 52-week high, we do believe this will become a lot more attractive given its yield right now at 5.06%, with rates cut already at 50 basis points this month, expected again in November. We do expect a lot of money that is currently on the sidelines to come into these yields, especially a company like Realty Income that does in fact pay on a monthly basis. We also see the P to FFO around 14.9. Over the last 12 months, we're outperforming the S&P. Over the last 10 years, up around 52%. Hasn't quite recovered from the COVID drop in 2020 at $82, but we wouldn't be surprised to see it reach those highs over the next few years. In terms of performance against management targets, well, they actually outperformed 2 of the last 4, 50% track record, with the more recent being a beat. Over the next 4 quarters, they are anticipating some nice growth to the earnings per share year on year, and as we can see, that will lower that forward P to FFO around 14.2. In terms of dividend safety, well, 80 safe, nice to note, especially for a monthly dividend paying company. We have reasonable valuation with growth around 3% over the last full year. Not the greatest, not the worst. As always, ideally bare minimum 4%. This score was just reaffirmed in August, and we can in fact see dividend cut looking unlikely. Now, in terms of the last recession, while they did increase the dividend, they had above average growth, and they also marginally outperformed the S&P, negative 43%. As we said, 3% increase over the last full year, 3% over the last 5, and a nice 5% over the last 20. As we said, they do also pay a very nice dividend yield. They're also a dividend aristocrat, 25 plus years of consecutive increases, whilst paying a dividend for the last 55 years without a reduction. Now, when we do take a look at the valuation model, zooming into over the last 12 months, this has been pretty much trading below its intrinsic value year on year. Right now, as we can see at the bottom of that bucket, but we do believe that it is still very, very attractive, especially for those that do use that income from the monthly payouts for any of their expenses. In fact, dividend yield theory still gives us that undervaluation signal, as well as the forward P to AFFO of 14.7, which is lower than the 5-year rolling of 17.2, as well as significantly lower than real estate as a whole at 17.4. Unlike other companies we've looked at today, free cash flow is more volatile for REITs, so we draw your attention to the adjusted FFO, funds from operation. Below 90% is what we target for REITs, been below that over the last 10 years, in fact decreasing, 76 over the last 2, 74 over the next 12 months, so no worries whatsoever. We can start to understand that safe dividend score. And adjusted FFO, we do like this consistent increases and expect it to continue over the next 12 months. Then when we look at sales growth for REITs, a little bit different. We want 5 to 10%, as well as seeing increases to the adjusted FFO per share, which is what we get. Very nice year on year. 2% in 2023, a little bit too low. We do want to see around the 4% as a minimum, which we can see on both the trailing 12-month as well as the next 12-month target. Sales have also increased very, very rapidly. In fact, more than 4 times, 1 billion to 4.08 in 2023. One thing we would say, typical with REITs, they will dilute your position over the longer term. Realty income do this at a much more rapid rate than others in the industry. Reason for this, they don't retain a lot of that internally generated cash flow. They do end up paying the majority out as dividends. Then we get to the ROIC. For REITs, we want 3 to 5%, pretty much what we see for realty income, around 3% in fact over the last 2 years. Ideally at the upper end, not something we have seen yet from this company, although the majority of the last 10 years, it has been around that midpoint of 4%. Operating margin also looking fairly attractive, fairly consistently as well in the 40% year on year, 44% on a trailing 12-month basis. And the one thing we would like to see with this company is the net debt to EBITDA start to come down below 5.5, 6.05 in fact over the last full year. We want to see this come down to 5.18 as expected over the next 12 months, just to give more security, especially for those dividend income investors who want to see that on a year-on-year basis, as well as some nice increases, which are a little bit higher at the bare minimum than the 4% inflation. Now, our intrinsic value of $69.15, marginally higher than Wall Street of $68, where they see 9% upside. And when we look at it through the MOS at 10%, pretty much where we see it right now. So realty income, a 10% margin of safety, 9% upside. Again, while this may not have the most margin of safety, this could be attractive for those people having money on their sidelines and thinking interest rates will come down. Consider this for that monthly payout. Just quickly before we end the episode, at 15%, a buy at $59, at 20% at $55, and at 25% around $52. As we said though, today's episode, 10%. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter, which we will be dropping a new copy on Monday with a new edition of October Undervalued Stocks. And as always, come and join us in the Patreon where we do run through our weekly buys and sells. As always, have a great day and we'll see you all on the next one.